of you have thought about excluding your entire asset sale from being taxed by the IRS? I've heard this question from so many people. People ask me, hey man, how do we exclude the gain from a sale of a home? How do we protect ourselves and grow our business? How do we grow our accounting, our real estate business? How do you gain a step ahead of the IRS? Well, here's the deal. You guys got to know about 1031 exchanges. It's the hottest thing in town. Everybody's heard of it. Real estate investors, real estate developers, homeowners, landlords, property managers are always talking about the 1031 exchange. Let me explain to you in detail on how these 1031 exchanges actually work. So let's say you have a property of $1 million. Let's say you're going to sell it for $950,000. When you go and sell it to a buyer without a 1031 exchange, you're going to end up owing a big, fat tax liability. How do you avoid that tax liability? Well, you do a 1031 exchange. You essentially go out in the marketplace, you find another property that is worth $950,000, you do a like-kind exchange, aka a 1031 exchange, and boom, the entire asset is a tax-deferred asset. Now, there are certain rules around this. A lot of my clients, they skip around the rules, and then they're late, and they panic, they don't understand what's going on. So you gotta get this done in 45 days. That means you gotta find a buyer within 45 days. If you don't, well, tough luck. And even crazier, you gotta complete this transaction in 135 days. 135 days is not a lot of time. So you're stressed, you're looking for brokers, you're looking for real estate advisors, you're looking for buyers, you're in a very tough spot. What do? Well, you hire a CPA early on in the process who's gonna show you, guide you through a 1031 exchange. What you can even do is, you can get the buyer to delay the purchase through delay tactics, which a CPA will show you how to do. And then while the buyer is delaying purchasing your home, you can go out and find a relatively similar property in the marketplace and then get that transaction completed. And boom, you've got a tax-deferred asset for 1031. You can also do partial exchanges. So let's say you've got a property that's worth $800,000 and you really like it. You can't find any other property that's worth $950,000. You can go ahead and get that property for $800,000, but you'll have to pay the difference. You'll have to pay taxes on that $100,000. So it's always better to go out there in the marketplace and find a property that is $800,000 or worth $950,000, similar in value, similar in nature, and reap the benefits of tax-free assets. Cash flow, that's what all real estate is about. Now, the Tax Cuts and Jobs Act recently changed some things. Used to be that personal property like your HVAC, your plumbing, your kitchen, your appliances, your cabinetry, your flooring, your roofing, everything used to be part of your real property, but now it's segregated. Your personal property is no longer part of your real property 1031 exchanges. What do? Well, you've got that as a tax-deferred asset, but then when you hire us, a real estate specialized CPA, we'll go in and do some cost seg studies, cost segregation, we'll break down those components and do 100% depreciation, 100% bonus depreciation on those assets. So boom, now not only do you have that real estate personal property depreciation, you've got the real property write-off in terms of no tax payments, and you're living that amazing life. For more tax strategies, keep watching these videos, keep liking, keep commenting, and more content is on the way, baby.